All right. Hello, everybody. I'm Tyler. Welcome to Intrudy Wealth Webinar Wednesdays, the Andrew and Tyler Show, whatever you want to call it. We're open to suggestions at this point. Um, I'm Tyler. I'm the relationship manager here. You all know Andrew Barnes, who he's my lovely co-host, or maybe I'm his co-host, however you want to put it. We're also joined by Patrick McMahon, and I'll turn it over to Andrew here, and he'll tell you a little bit more.
Excellent. Thank you, Tyler. Yeah, we're excited. We have Patrick McMahon here, and let me just introduce him very quickly. Patrick partners with clients and their advisors to incorporate insurance into comprehensive financial plans, and he focuses on designing tailored solutions that support long-term goals like retirement, wealth protection, and legacy planning. Some interesting things about Patrick. He graduated from Cal Poly San Luis Obispo with a degree in journalism, taught special ed for a couple of years, and then got started into the financial services industry. And in his free time, Pat enjoys skiing, fly fishing, golfing, poker, and competing in any sport. And he is a diehard Green Bay Packers fan and a proud shareholder. One thing that I like about Pat as well is Pat is a Bakersfield guy. And Pat, I think you live just on the east end of town, right?
That's right. Yeah, I grew up northeast side of town. Went to Highland High School in my younger days, and I'm back out here now after spending about 10 years bouncing around different parts of California. I've been back for a couple of years now, and I live out by City in the Hills in the far northeast side right now.
Excellent. Excellent. Well, with all of that, Pat, I will give you the reins, and I'm interested to hear what Pat can tell us about long-term care, which is one area of the insurance market that Pat is very knowledgeable on and helps us navigate for our clients. So, Pat, take it away.
Perfect, Andrew. I appreciate the nice introduction there, and yeah, just to kind of finish that thought out in a simple way. Essentially, what I do here is I'm here to be the insurance expert for guys like Andrew, Tyler, and Brad, so that they don't really have to be, right? They can focus on what they do best. They can grow your assets, help you get your retirement plans put into place. When their clients need insurance, I'm the one who can kind of provide the expertise and access to the marketplace for them, whether it's life insurance or in this case, for long-term care. So today, we're going to talk about the problem, how much it might cost, and how we can use insurance to protect your retirement plans. So let's talk about who needs long-term care. Currently, if you are 65 years old today, there is a 70% chance that you will require some form of long-term care. So we've got about 30 people out of 100 who will not need it. Perhaps the most concerning stat is that out of all those folks, only 10% of people actually have any kind of protection in place, which means for every 165-year-old people, we're going to have about 63 of them who are going to need long-term care and not have anything in place to help pay for it. So there we go. If we were to look here at this snapshot of 100 people and assume that 70 of them are going to need care, you can see that the likelihood of a couple needing care is even higher. So about 4 or 5 couples are going to get lucky. They're going to be in the clear. That's 9%. About 20 to 21 couples are going to have one person who needs care. And about 25 of those 50 couples, or 49%, are going to have a situation where both people need care. So 91% of the time for a couple, both age 65, we're going to have at least one person needing care. The risk obviously is very, very real. So let's take a moment now to talk about how much long-term care can actually cost. These are averages for California. I'd like to think here in Bakersfield, the costs are probably a little bit lower than the state average, but this should still give us a pretty good idea of the pricing. And these are 2024 numbers that are based off of a survey from last year. The future numbers are based just off of a basic 3% compound inflation rate. So as you can see, the care is certainly not cheap. Some people will end up in nursing homes. I like to think the majority of folks would prefer to stay at home, stay in your own home, stay where you're comfortable. So to me, I tend to focus more on the home healthcare numbers, which again, still not cheap, $7,200 a month right now. But those are the numbers that I tend to focus on for a goal to protect against. Now, obviously, some people want to have more robust protection in place. But I think if we can at least cover the cover the cost of home health care, then we'll be in pretty good shape. Now, um, how long are people going to need care for? Well, most people will need care for between 1 and 4 years. The average is right about three, a little bit more for women, a little bit less for men. But I like to remind folks that for every person who needs no care or a very brief amount of care, there's someone else who needs 5, 8, or maybe even 10 years of care on the opposite end. And I think perhaps the biggest risk to insure against aren't necessarily physical ailments, but the mental ones. So things like Alzheimer, dementia, Parkinson's, those can carry a life expectancy of 10 years or more. And so, what I like to ask people, not because I want them to be scared, but because I think it's an important question to have to answer, is if you had to come up with, call it $10,000 a month for long-term care for 10 years, it's $1.2 million. How would you do that? And hopefully, it's not just coming out of your retirement account, because that's what we're trying to avoid. So, hopefully, I've at least got your attention at this point. But before I get into the solutions and how we solve this problem, I just wanted to share a little bit about my own family story and kind of history here with long-term care. These are my grandparents, rest in peace. Robert Leonard Williams and Betty Joanne Brown were married on September 17th, 1950. They'd known each other for all of 9 months after meeting at a naval officers' ball. There's the happy couple. We're fast forward here to 1988. That's when I became part of the story here. Luckily for me, I kept the hair. I lost some of the weight. But one thing about my grandparents is that they both loved kids. They had two of their own. They adopted three more, and they served as foster parents to many others. Throughout their 60s and 70s, life was good. My grandfather worked with his son, with my uncle, as well as my own father as an attorney in their local family practice, Williams and Williams. You may have heard of it. My grandmother continued to work as a private reading tutor for children, an endeavor she took part in for more than 50 years. But in December of 2002, things changed. My grandfather had his first stroke. It landed him in a skilled nursing facility for 3 months until he was able to return home, but he was still not really back to his former self. This picture here was taken on his birthday, right before he was hit with his second stroke. My grandfather never recovered from his second stroke. He became permanently bedridden, and he also lost the ability to speak. If it weren't for his ability to use his left arm and communicate through hand squeezes, we really wouldn't have been sure if he was still mentally there. Days like this one here on Easter were the only days he was able to leave the facility, and it took an entire team of people to move him. This is the last time I saw my grandfather. It was in 2008. You can see the firm grip with his left hand because that's what he still had control over. My grandmother's story is a little bit less heartbreaking, but she still needed extensive care nonetheless. Less than a year after my grandfather's passing, she was diagnosed with Parkinson's and Meniere's disease, and she needed assistance for 8 hours a day. Then in 2011, she fell and she broke her hip. She would never fully recover. She then needed 24/7 home care until she passed away in April of 2015. So I can tell you from personal experience that needing a combined 12 years of care is absolutely not out of the question. It happened to my family, and it was not cheap. Um, I don't want this to be, a sad day. My grandfather was fortunate enough to have a lot of his costs covered because of his military background and service in World War II. But my grandmother spent a lot of her money on her own care, money that her children should have gotten. So, with all that said, what I want to talk to you now is about the solutions and how we can make sure that you and your loved ones don't have to absorb what can be a really huge financial burden. So, how do we solve a long-term care problem these days? Well, we've got three main ways that we can do it. We've got a traditional long-term care policy, which is what a lot of you may be familiar with when you hear the terms long-term care. We've got life insurance with a long-term care rider, and we have a hybrid asset-based style long-term care solution. So let's start quickly and review traditional policies. This is again what you probably think of when you hear the terms long-term care. Now, the good thing about it on the surface is that it's the lowest cost, at least on paper. The problem, though, is that the premiums are non-guaranteed. And so while it may look cheap today, what you're going to see is a pretty significant history of rate increases in people who bought policies 10, 15, 20 years ago, paying twice as much or more now than they did before with no end in sight. And of course, the problem as well is that as you get older, you need your assets more. Well, the care is getting more and more expensive, but it also is not going to be replaceable. So you can find yourself in a position where you really don't have much of a choice but to just kind of bite the bullet and pay whatever they're asking you to pay. It is also a use it or lose it product, meaning if you buy it, you pay for it for 10, 15, 20 years, you never end up needing long-term care because you're one of those 3 out of 10 people, you get nothing for it, right? You get absolutely nothing for it at all. And a lot of carriers are actually leaving this part of the marketplace as well. It's not to say that it's never the right solution, but it's rarely the right solution, in my opinion, when all the different options are available to us. The bright side here, though, is that some of the issues with these contracts that people have experienced in the past have directly led to some of the newer, more efficient solutions that remove some of these problems here. So, you have heard about life insurance. You know that it pays your loved one a benefit after you pass away. But did you know that your life insurance can work for you while you are still alive? By using a permanent life insurance policy and adding a long-term care or chronic illness rider, we can create a scenario where you would get guaranteed leverage on your money. You might need the money for long-term care, you might not. But regardless, the total benefit to you or to your family will be greater than what you have paid into the policy. The benefits will always be tax-free as well, which of course is a big advantage over self-insuring and just paying for this money out of pocket. So let's talk for a moment about the life insurance and long-term care features. Now, it is a higher cost product than the traditional, but that's of course because we're getting a lot more value out of it. It's going to provide us with the strongest death benefit leverage in the event that we do not need care. So in other words, if we want to get good value out of this contract, whether we need care or not, this is a very, very powerful way to do it. It is a two birds with one stone approach. Basically, what I mean by that is that it can cover an unexpected death in the short term, life insurance, of course, or it can cover illness in the future. So for people who have insurance needs today, you've got a mortgage, you've got kids in college, you've got, a business that needs to be continued, some reason why you need to protect your own life. Well, we can get that coverage in place and at the same time add in a long-term care or chronic illness feature, which basically allows us to double dip, right? If we have something in the short term, we're going to get that death benefit. And if we live a nice long life and we need the long-term care later, we can then access that pool of money for the long-term care instead. We can put optional full guarantees on there. We can get into the details later, but of course, you pay more for guarantees. You pay less if you don't need the guarantees, but not important right now. And when I say it requires average or better health, that's not necessarily completely true. I would say I recommend you being an average or better health. And the reason for that is these are what they call fully underwritten products, which basically means the price that you pay will be directly related to your health and your health history. So for people who are in good health, they're actually going to get a discount compared to what other people may pay. It can be a really, really nice fit for them. For folks who are in less than average health, we've got some other solutions that I'll get to here in a moment that aren't going to ding you for those concerns as often. And so there may be a better option available to those types of folks. And I say here is an ideal alternative to self-insuring against long-term care needs. And again, what I mean by that is if you self-insure against long-term care, well, whatever your costs are, they're coming out of your pocket directly dollar for dollar. If you buy an insurance policy, we know that whether we need it or not, we're going to get leverage on that money. We're going to get more than we paid into it, and it's going to be tax-free. Again, it might be a death benefit for our beneficiaries. It might be direct payments for us to get long-term care needs taken care of. But either way, it should cost you a lot less than just self-insuring with your own assets that you've worked so hard to grow. So I'm going to give you an example of how this might work. I've got a gentleman here named George. George is 56 years old. He's in above average health, but it's not perfect. He'd like to retire in about 10 to 12 years, but as I mentioned before, some folks have insurance needs, and George is one of those folks. He's got 2 kids in college. He's got 15 years left on his mortgage, and so he needs both short-term protection for his family, and he has long-term care needs in the future potentially. So how do we take care of this for George? Well, one option here for George is that he's going to put $150,000 into his life insurance policy. The policy is projected to last for his entire life and most likely will not ever require any additional money being paid into it. The death benefit that George is going to receive is $705,000. So you can see right away, we've more than quadrupled his money that he's put into it for purposes of either long-term care or for death benefit. The rate at which he'll have access to that money is 2% per month, and that is 2% of the $705,000. So if you think of it from that perspective, if we have the full benefit available to us at 2% per month, that gives us 50 months. So just over 4 years of protection, which is enough for most people. And that's going to allow him to access up to $14,115 per month for his long-term care purposes. If he spends, for example, $200,000 of that money on his care and then passes away, his family is going to get the remaining $500,000. Of course, if he doesn't use long-term care at all, his family is going to get the full $705,000. And in the event that he does need significant care for 10 years, perhaps, he can take the entire $705,000 out over the course of 50 months to pay for his care the entire time. So from a leverage standpoint, we're getting long-term care coverage for 21 cents on the dollar, or another way to think of it is 4.68 to 1 tax-free death benefit leverage if he doesn't need the care. So again, the idea here is that we're going to take your assets, we're going to leverage them up. We might need long-term care, we might not, but either way, you are not going to be in a position where you're spending $400,000, $500,000, $600,000 out of pocket. Instead, we're putting in $150,000 and we're going to receive $705,000 back. Now, and assuming a 30% tax bracket here for George, that $150,000 would have to grow to over $1.15 million before he died to pass down the same $705,000 to his beneficiaries. So one of the things we talk about insurance is a little bit of an aside here is the mitigation or the transfer of risk. That's not to say that you can't grow your money to 1.15 million before you pass. Some people will. And if you're going to get 20% a year on returns, then maybe you can do that. But there's a lot of risk involved. The risk of needing care sooner rather than later, the risk of passing away, of course, and of course, the risk that the markets are not going to cooperate and you're not going to get nearly the return that you'd hope for to be able to get your assets to that point up. So what we're really going to do is just shift that risk from our own portfolio onto the insurance companies instead. Now, not everybody's got $150,000 laying around, so there are a lot of different ways we can structure a policy. It can be paid for your entire life, 10 years, 20 years, 35 years, until you're 85 years old on the dot. Really, it can be customized to any level that you want to see. But just for an example here, I'm just going to show you what it would look like if we paid for 20 years instead. So this time, for the same exact benefits, the same $705,000 benefit with $14,000 a month access for long-term care, we're going to spend $11,000, basically $11,051 per year, and that's scheduled to be paid for 20 years. So of course, if you pay it sooner rather than later, for example, one premium of $150, it's going to cost you less in total just due to the time value of money. But assuming he paid for the full 20 years, his total cost for that $705,000 would be $221,000. So we're still getting more than 3-to-1 tax-free leverage on that money for George here. Now, the next concept that I want to talk about here is the asset-based long-term care solution. Not everybody is young enough and healthy enough for a life insurance policy to make a ton of sense, but luckily there are a number of what we call asset-based long-term care solutions. And when we say asset-based, the way you can think of it is you're repositioning some of your assets into this product that's going to be protecting you from long-term care, but if you don't end up needing it, those assets are not going to disappear like they would on traditional policy. They are designed to provide more efficient long-term care coverage at a lower price than the other policies with also more liberal underwriting. The trade-off is if you don't need the care, you're not going to get the same type of leverage as you would on a life insurance policy in the form of a strong death benefit. So unlike a life insurance policy with a long-term care rider, which provides a defined bucket of money that can be used for long-term care or for a death benefit, the asset-based hybrid plan will provide less death benefit leverage, but more long-term care leverage. So in other words, if affordability and long-term care protection are your main concerns versus leveraging your money up, this might be the right option for you. These also can be really good options for single individuals who are more concerned with their own ability to pay for care rather than making sure that their family continues their standard of living if they pass away unexpectedly. So it's not a question of how many assets am I going to pass down? It's a question of, am I going to have enough assets to retire and live comfortably if I end up needing significant money for long-term care? I want to make sure that I don't run out of money. So how do these things compare? Well, it is a lower cost solution. So it's going to slot in right between a traditional policy and a life insurance policy, sort of a middle ground option. as far as cost goes. We also have joint products available. So we can put a husband and a wife on the same policy for even better rates. And for the most part, every single hybrid policy is going to be fully guaranteed. So the benefits you receive, as well as the rates that you have to pay, are going to be locked in the day that you buy it. It also has a death benefit to prevent the use it or lose it problem. But again, it's not going to be leverage. It's more of a money back scenario typically. And we've got pass fail underwriting. So I mentioned before, the life policies do really well for people in good health because you get a discount for being in good health. Whereas a hybrid solution can be a really good option for people who have some health concerns because of their pass fail style of underwriting. So literally you could be, 50 pounds overweight, take a medication for high blood pressure and cholesterol, and you're going to pay the same exact price as your guy down the street who runs marathons in his free time because you both got the pass and not the fail. We also have some products available that can even provide unlimited lifetime benefits. So for folks who've got family history or just concerns of longevity and thinking, well, I might be one of those folks who needs care for 6, 8, or maybe even 10 years, we can get you a policy that can provide benefits for your entire life, fully guaranteed as well. So how does an asset-based long-term care solution work? Well, the client is going to pay premiums. We're going to get a small death benefit that prevents the use it or lose it problem to kind of protect that loss of principal. During the long-term care claim, your death benefit is going to be spent down. So similar to the previous option where your death benefit decreases based on the amount of money you spend, the same thing happens on these type of policies. However, the difference is once your death benefit reaches zero and you've sort of quote unquote spent your money, you're going to continue to receive extended benefits after your death benefits reach zero, at which point you're basically just spending free money, the carrier's money at this point. You're effectively going to cap your total out-of-pocket expenses for long-term care. Once your death benefit is spent, you continue to collect long-term care benefits at the insurance carrier's expense. So here's an example of how that might work. What I've got here is Robert and Diane. They're both 65 years old, and their concern is that long-term care could ruin their retirement plans. We've also got some health concerns, and I changed the names, but these are actually based off of a real couple that I had worked on in the past before. Robert here had prostate cancer. He had surgery to remove it about 5 years ago. He also had high blood pressure and high cholesterol. Both were well controlled with medication. The wife, Diane, had a history of ovarian cysts, migraines, and acid reflux. What they had done is they basically set aside $100,000 each to protect themselves for long-term care needs. And what they found is that a joint asset-based long-term care plan with lifetime benefits was the ideal solution for them. So we put $200,000 in the policy, the $100,000 a piece. What that's going to get them is a death benefit of $196,000, almost $197,000. And again, this is not here for leverage. This is to prevent the loss of principal. So effectively, if we're in a scenario where they never need care their entire lives, they're basically getting their money back. Now, of course, there's a time value of money factor, but again, the whole point is shifting the risk to the insurance company in the event that you do need long-term care. What they're going to get out of this is they got $8,200 a month for long-term care per person, and that is an unlimited lifetime benefit. So both of them have access to $8,200 a month. That'd be $16,400 combined if they're both needing it at the same time. And that is a lifetime fully guaranteed benefit. So really the way this plays out here is their total maximum cost is $200,000 and their minimum total benefit is $196,778. So basically the worst case scenario is that they break even. But what they're going to get out of that, again, is the $8,200 a month per person forever, fully guaranteed. I just like to throw this in here for my grandparents. If they had bought this exact policy, they would have received almost $1.2 million for long-term care during the 12-year period that they needed care. And so obviously, if you can take $200,000 and leverage that into almost $1.2 million, that's $1 million of assets that would not have been spent, that would have gone to family, beneficiaries, kids, grandkids instead. I think that's a heck of a deal. There's another kind of hybrid solution that we can use to have benefits that grow with you. And this often works well for people who are a little bit younger, who think they're going to need higher levels of care in the future. So people who are mainly concerned about their personal long-term care, or folks who don't think they'll need it for 10, 15, 20, maybe even 30 years plus, we've got some pretty affordable long-term care solutions with benefits that will grow as the price of long-term care goes up as well. These contracts can also offer us 100% liquidity. I don't want to get into the weeds too much here. There are some that do, some that don't. Typically, if you'll take less liquidity, you'll get a better deal. But the point is that if you're worried that you may need this money someday, or let's say you've got money sitting in an emergency fund that's really not earning any interest for you, it's not doing much, it's just sort of sitting in cash. Well, this is a way that we can reposition those assets, put it into something that's going to provide you with long-term care protection. And if that emergency does arise, and God forbid you feel like you have to surrender the policy, you can surrender that policy and still get your money back. So it's not really spending money, it's really just moving it from one pocket to the other. So here's an example for you for a woman named Barbara. Barbara's 50 years old, but her husband is in declining health. She doesn't think he's going to be around a long time in the future. They've got adult children, so their concerns really aren't about paying for kids' college or anything like that. Their main concern, or Barbara's main concern, I should say, is affordability of care and being able to stay at home. She thinks she'll probably need care around age 80 because that's when her parents' health began to fail. And we've figured out that by age 80, I think actually I've updated this to 10,000 to today's numbers, and I think we'll see on the next slide. We're going to need $9,000 to $10,000 a month to pay for her own home health care that she wants to be able to get. So for Barbara here, what we've done here is we have done a one-time premium. And again, we have options to pay for this for a longer period of time. Typically, these can be paid for as long as 10 years. Her price would probably be around $8,000, $8,200 a year. So it costs her $80,000 to $82,000 instead if we paid for it over a 10-year period. But for this example, we do a one-time premium of $75,000. She's getting a minimum death benefit of about $99,000, just shy of it, to ensure that her money will not be wasted, even if she does not need care. And after she's had the contract for 5 years, so by the time we get to year 6, she can surrender the contract and they will give her $75,464 right back. So she'll get 100% of her money back starting in the 6th year, and she'd have up to 80% of available to her starting in day 1. So basically, day 1, you can get 80% of your money back. And over the course of those next 5 years, that 80% grows to 84, 88, 92, 96, and then reaches 100% by year 6, so that you'll have full liquidity access to that money. Her benefits are structured to grow to $10,000 a month when she reaches age 80, and she's going to have a total of 6 years of coverage. So day 1, we're at $4,100 a month for long-term care. She's got $319,000 total. I don't need to read every single number to you here, but as you can see, the benefits are growing over time. So by the time we hit age 80, which is our targeted age, we're going to be up to that $10,000 monthly benefit number. And we have over $776,000 of money available to her in total. So it took us 30 years from age 50 to age 80, but we've basically created a scenario where we have tenfold tax-free leverage on her money for LTC. Her $75,000 is now protecting $776,000. And those benefits will continue to grow as well. So if she doesn't need money at age 80, but instead it's age 90, 85, 90, 95, whatever it may be, you can see at age 90, we're up to almost $13,500, over $1 million of total long-term care. She made it all the way to 99. We're up to almost $17,500 with a total long-term care pool of $1.36 million. And again, that's going to be received over a 6-year benefit period should she need it. So other factors here, just that I want to mention, health concerns. A lot of people just sort of think, well, I like the idea of long-term care, but I don't think I'm going to qualify for it. I've got some health concerns. That's something that we can definitely help with. We have direct access to carrier underwriters, which basically means that we can discuss your specific case with the carriers and determine, is an application worth even putting in? Is it worth the time and effort before we push you through any kind of exams or testing, anything like that? Existing insurance. Maybe you have life insurance already. When is the last time you checked to see how it was performing? Free of charge, we can do a policy review for you. Basically determine, does your existing policy meet your needs? Can we make recommendations on how we can improve it? And does a long-term care rider or new policy or new solution fit in with your current scenario? Or maybe it makes sense to replace what you have with something that can cover more of your bases at the same time. But either way, essentially what we can do is a free insurance audit for you to make sure that what you have is doing what you expect it to do and it's not heading towards a problem for you in the future. And is this going to cost you anything? Not a penny. You will never pay for anything other than the insurance itself. You'll get the proposals, you'll get all your best options, all of our time, all the consulting, everything's going to be free of charge. Again, the only thing you'll ever actually pay for is the actual cost of the insurance policy. So, with all that said, I appreciate you letting me ramble here for a while. If you took three things away from this today, I would hope that it would be number one, most people are going to need long-term care, and the costs are very, very high. Number two, there are ways that we can preserve your assets even if you do not need the care. And number three, Brad, Andrew, and Tyler, sorry I forgot about you, buddy. Tyler, too, we are all here to help you every step of the way. We work with every reputable A-rated insurance company in the country, at least the ones that offer a brokerage arm that aren't only direct to consumer. So we are uniquely positioned to provide you with multiple unbiased options and help you make the right choice. I'm not here to sell you any specific insurance product. I'm here to bring the entire insurance marketplace to you and help you narrow down and find the ideal solution for you and for your family. And you don't need to know what solution's right for you. You don't even need to know how much coverage you want or need or what you can afford. All you need to do is be willing to view your options and let us help you make an informed decision. So with that said, I don't know, Andrew, Tyler, if any questions have come in, but I'm happy to take some questions here. Any comments, any concerns anybody may have?
Yeah, how could you forget me?
I'm sorry, buddy. I'll get you on there next time, I promise.
Hey, Pat, I've got a question for you. I hear a lot of people say in passing, or, if insurance comes up, that insurance companies are there to collect premiums and then deny claims, figure out ways not to pay. What are your thoughts on that? I guess in the life insurance world as a whole, and maybe specifically with long-term care.
Sure, yeah.
It's a different animal than your home or auto.
Exactly. And I think that's a really good point. And your experiences with auto insurance, with home insurance, or even with health insurance, those are going to be subject to a lot more scrutiny. There's more fraud that can potentially happen, people lying about things. And so, yeah, insurance kind of has a tough reputation in that arena, probably for good reason. But I think certainly with life insurance, things are a little bit different. And forgive the morbid joke here, but it's a little more obvious if someone has a life insurance claim because they're not alive anymore, right? You're either dead or you're alive. So if you're dead, your insurance policy is going to pay you. The only reason that an insurance policy wouldn't pay would be within that 2-year contestability window if there was a suicide, or if the client did what they call a material misrepresentation of the facts. And basically what that means is not only did you lie about yourself on the insurance application, but you did it on purpose, right? So if you forget something, if the insurance company doesn't find something out and they give you your policy and it's just an honest mistake, that's their fault for not underwriting the policy well enough. You will still get paid in full. But if they ask you the question of, oh, have you ever used tobacco? And you say, no, I've never smoked in my entire life. You die of lung cancer and they look and they say, wait a second, you've been using tobacco since 1980. It's in every one of your medical records. Your doctor's been telling you to stop. That's the kind of scenario you might find a problem. But outside of doing something highly illegal and unethical, insurance policies are always going to be paid out. So that's at least on the death benefit side. When it comes to the long-term care side, I think one of the really nice things is that it's your doctor who is making the decision. So what it's going to require, and I probably should have gone over this, but the way you qualify for a long-term care need is your inability to perform 2 of 6, what they call activities of daily living. Those are things like being able to feed yourself, put your own clothes on, getting up in and out of bed, bathe yourself, etc. If your doctor signs a letter that you can't do 2 of those 6 things, that's going to be what allows the insurance company to start paying you. So they're not sending their own examiners out to try to test you and try to tell you why you're not going to qualify or why you can do the things that you say you can't. It's your own personal family physician that you've seen and known for hopefully a large part of your life, who typically is going to have your back, right? If you tell them, hey, doc, like having some trouble doing this, I need some help at home. I need you to sign this or write this letter so that I can start getting paid. They're going to say, sure, absolutely. You're my client. My best or your best interest is what I care about. I don't care about these insurance companies. I'd be happy to write that letter for you. So, from that perspective, at least in my experience, I've been doing this for 11 years now. I have yet to see a single client have anything more than some minor inconveniences with paperwork and processing. I've yet to see any claims be denied or any companies say, sorry, we're not going to pay you. They get those letters from their personal doctor, they get that care in place, and they're off and running.
Awesome. We do have I got a two-part question here.
Uh-huh.
From Tim, who wants to know, can it be paid out of a 401k? So we'll start with that one.
I
So,
think he means the premiums.
yes, I assume the premium. So the life insurance world does not take qualified money. So any sort of pre-tax money has to be basically converted into after-tax money first. Now, with that said, there are some companies who will give the appearance that they'll take qualified money, and they'll do that by basically creating an annuity inside of their product that then spits out distributions that your client will receive a 1099 on and pay taxes on, and then fund the policy from the inside out. Now, that's an okay way to do it, but in my experience, we can actually typically be more efficient by doing that ourselves. So let's say, for example, we've got a few $100,000, a couple $100,000 we want to use for long-term care, but it's all qualified money. Well, what we do is we buy our own annuity that provides, for example, a joint lifetime income stream for a husband and wife. We then factor in the taxes on the front end, use the after-tax amount to then fund the life paid long-term care solution, and effectively get it done in one transaction because the annuity payments are guaranteed. They're going to pay for the insurance. You never have to think about how am I going to pay for this, but it's sort of an extra step involved to be able to pay for it with any kind of qualified money.
All right, then
So not directly, but in a roundabout way, yes, we can essentially.
gotcha. And then the follow-up, is it being paid out based on billing and receipts from the care facility itself?
Great question. So there are two different styles of payout that we can be looking at here. The first one is called reimbursement, and it's just like it sounds, where you will be reimbursed for your incurred expenses up to your maximum monthly benefit. So I had an example earlier where somebody was getting up to $14,000 a month for 50 months. Well, if their care only cost them $10,000 a month, the insurance company is going to send them $10,000 a month, but that actually would result in more of the assets being preserved because we're spending down the death benefit at a slower rate. And it also means that the death benefit will last longer, which means you can actually get long-term care for more than 50 months in that case. But the reimbursement style reimburses you for your incurred expenses. There is also a second style rider called an indemnity payout. The indemnity payouts will pay you up to your maximum benefit once you've proven that you qualify for care. And that's going to be whatever you get, you can do whatever you want with it. So if you receive $10,000 and your care only costs six, you have that $4,000 to do anything you want. It's going to be tax free as well. The only caveat there is the IRS has what they call a HIPAA per diem. Right now, I think we're around $13,000 a month. It goes up typically every year, around 3%. Some years it doesn't go up, some years it goes up more. But basically, let's just call the HIPAA per diem 13,000 today for easy math. If your life insurance policy paid you $15,000 on an indemnity basis, you could say either A, just give me 13 because I don't want to pay any taxes and just take the 13 only, or you could say, you know what, give me the full 15. The first 13 is tax free up to the HIPAA per diem. I'm going to realize $2,000 of gains on the situation. I'll pay taxes on the 2 grand, but I'd rather do that than leave the money in the policy. And these are choices that can be made at time of claim that we can figure out kind of financially what makes the most sense. I do surprisingly often see scenarios where I usually recommend taking it and paying the taxes. And that's usually because not everybody's going to live for the full 6 years and receive the full benefit. So my usual advice is if they're going to give you the money, take it, pay the taxes and invest it because there's no guarantee you're going to be alive 3, 4, 5 years from now to continue to receive those benefits. So instead, get as much out of this policy as you possibly can, and then pay it a little bit in taxes if you want to. But it's completely optional and up to the client how they want to do that.
Awesome. All right, then
We have a question. Can the government help with long-term care? What does that look like?
Oh, maybe kind of, but not really. So Medicaid is a thing. There'll be some expenses that can be covered, but the problem is that the Medicaid eligibility typically requires a spend down. And so you're not going to qualify for government assistance until you've basically spent your assets down to near zero. Now, there's some ways to shelter a few things here and there, but if you have significant assets and you need long-term care, the government's not going to come in and help you. So they will help people who have nothing. There'll be something there for them, but that Medicaid spend down rule basically means that you're going to blow all your money first before you're going to get any assistance from the government. So I always tell people don't rely on the government to pay for your care because unless you've spent all your money first, you're not going to get anything. And the whole point, in my opinion, is protecting those assets in the first place and making sure they don't get spent down.
Good answer.
Awesome.
Any other?
And just a preface, I am not a tax advisor. So, I'm not a financial advisor. I'm not a tax professional. I'm an insurance guy. So those are my understandings of things. But of course, you would always want to double check with your tax guys and make sure that there's not something that I could be unaware of or things could always change, of course.
Sure. Any other questions?
All right. Well,
Yeah, Tyler, I'll close out if you don't mind. I think the thing to know is, like Pat mentioned, the need is real, and you have people in your corner that can help. And so, any further questions that you may have, after the call, or if you ever want to look at this more closely, know that Brad, myself, Tyler, we're here. Get in touch with us. We could set up the time with Pat and take a closer look at this and help you navigate the complex world of life insurance, long-term care insurance, and help find a solution that would be a really good fit for you. So again, thank you for the time today. Appreciate you all being here, and let us know however we can help. And I want to wish you, hope you have a great rest of your day. Thank you so much.